Not all traders understand that every single candlestick on the chart screen represents information that will help them execute a better trade. Professional traders look for single patterns on the chart screen that will help them identify where and how they should set a trade, whether they should go up or come down. Candlestick patterns are very important aspect of trading, and professional day traders don't joke with it because they help them either in swing trading or in scalping. I mean the day-to-day execution of the trade, coming in and going out of the trade on daily basis. So they're going to learn all about that also. Professional traders understand that certain patterns on the chart screen, on the forex trading chart screen, will tell them information on how the market will appear in the next minutes. And that's what we're going to learn about in this particular video. Understanding certain patterns, important patterns that we use in executing our trade. So with that being said, let's dive into the video.
Hey guys, welcome back to another episode. In this video, we are going to show you how to trade chart patterns like a pro and how we apply these exact strategies to cryptos and stocks that we invest in and trade. You want to show your support? Please click on the like button, subscribe and turn on the notification bell so that you know exactly when new videos are released. So there are tons of patterns that traders use, but the ones we will be covering are the ones we find more effective and occurs the most often. By the way, my name is Nsika Kubara from Edumers Forex Academy, and today I'll be teaching you with the laptop version of the trading app we use. But if you are just starting out as a beginner and you don't have a laptop just yet, then you can just click on the first link in the description of this video to get access to the real website of this platform and create an account with your mobile phone to follow along with us as we proceed. There are so many fake scamming trading platforms all over the internet nowadays, so you should be careful with the trading platform you choose to avoid gambling with your capital as you are about to start this journey with us. Make sure you choose a platform that will allow you to withdraw your investments anytime you want to. Now, to get our full guidance on this issue, you can just click on the first link in the description of this video to watch how we go about it as well. Alright, let's get down to business. So let's get right into it. Starting with the first, which is a double top and double bottom pattern. Here is where we will be showing you the anatomy of each pattern. So first, you had your moving uptrend. Price that made two same highs. The top essentially make a resistance level. The swing low here is what is called the neckline. Now, what does the double top tell you from a price action standpoint? Price failed to make a higher high but instead made a same high, which shows a loss of momentum from the uptrend, meaning a loss of momentum from the buyers in the market. Now, going the other way, you first have a moving downtrend. Price that makes two same lows. The bottom essentially made a support level. This swing high here from the neckline. Now, what does the double bottom tell you in terms of price action? Price failed to make a lower low but instead made a same low, which shows a loss of momentum from the downtrend, meaning a loss of momentum from the sellers in the market. So this thing brings us to our next question, which is how do we use the double top and double bottom pattern as part of our strategy? Also, right now, go to the comment section below and tell us exactly what topics and questions you want us to cover, as we always look at the comments to decide what to create next. Now, these are the 4 core variations to use in the double top and double bottom pattern. Let's start with the first, which is neckline break entry. So you first have your double bottom pattern that forms neckline here because of the reason swing low. Now, once price breaks the neckline, it means a low line. You will take out trade entry short as the reversal and trend change is now confirmed. Going the other way, you first have your double bottom pattern that forms neckline because of the recent swing high. Now, once price hits the neckline and makes a higher high, you will take a trade entry long as a reversal and trend change is now confirmed. So moving on, the second variation, a double top or double bottom pattern forming at a key level. Now this is an entry that occurred on Ethereum and one that many of our members took. So you first need to identify a key level which you have through these 3 reversal points. As price comes back down, you create a double bottom pattern at the support level. So again, to confirm the reversal, neckline placed at the recent swing high, and once price breaks through the neckline, it makes a higher high. Your trend change from a downtrend to an uptrend is confirmed, and you will then take trade entries long through the lower intraday time frame. Now, to point something out, there was another trend change confirmation you could have used, which was placing a trend line like this, connecting the swing high, and again waiting for the breakthrough before looking for trade entries long. Now going the other way, again you first need to identify a key level which you have through these reversal points here, giving you your resistance level. As price comes back up, you create a double top pattern right at the resistance level. So again, to confirm the double top reversal, neckline placed at the recent swing low here, and once price breaks through the neckline, it makes a lower low. Your trend change from an uptrend to a downtrend is confirmed. We then take trade entry short to the lower intraday time frame. This is also a very good example of many different opportunities to enter trades. Some would have entered short right at this point here. Others would have entered short right at this point here, where pattern traders wouldn't enter into the double top pattern from, and then they break up neckline here. All are correct. There are multiple different ways to enter trade based on your style. So what does a double top or double bottom pattern at a key level tell you from a price action standpoint? This kind of entry is a higher quality because you are not just trading a pattern on its own, but a pattern that is also at a key level, which means you also have support and resistance traders looking to enter along with pattern traders, which helps create momentum for the trade and increases trade quality. So moving on to the third variation, a double top or double bottom pattern, but instead of taking the breakout entry, waiting for a pullback entry. So back to the Ethereum example we just covered, we have a double bottom pattern, neckline break, but instead of taking the breakout entry, there was a second long entry on the pullback to the new support level. This is actually a very good level as it was way back here. Now there is a very specific way you must place your stop loss when taking breakout entries, but then a very different way you must place the stop loss when taking pullback entries. So moving on to the fourth variation, candlestick pattern forming at a key level and then a double top or double bottom pattern inside of those candlesticks. So you first look for a key level which you have to this reversal point here, which gives you a level of resistance. As price comes back to this level, you are waiting to see if you would get candlesticks forming at the level to show reactions to the level of resistance which you got to this long wick candle. But a reaction does not equal a trade, as price can tell at this key level, form the level and still break through. Don't forget that this is a very strong uptrend, so what you need to do is, after you have your long wick candle react to the level of resistance, you need to look inside of this area, the lower time frame, to see if you can get any forms of price action that signals a trend change from an uptrend to a downtrend. Now this is a very key point. Before you look inside of this area, you have no idea of what you will find or if you will find anything at all. So let's pull up a lower time frame, especially the 6-hour time frame, and put it beside this one. So in the left of the daily time frame, we just look at, and on the right here is 6-hour time frame of the same assay. This resistance level here is the same resistance level here. This area here where the candlestick form is the same area here on the 6-hour time frame. The reason we are using a lower time frame is because on the main time frame, what we found on the initial setup Price movement is two types, meaning we don't have good swings that gives us good price action that signal a trend change after we had the long wick candle. Whereas here on the lower time frame on the right, you can see so much more data and see the actual swings and price. So what you had on this lower time frame was a perfect double top pattern that formed right at the key level of resistance and inside of the long wick candle from the higher time frame. So again, to confirm the reversal and trend change, neckline placed here at the swing low, and once price breaks the neckline and makes a lower low, your trend change is confirmed from an uptrend to a downtrend. The breakout here is then when you would go to the lower intraday time frame to take trade entry shots. Now I'm going in the opposite direction. In a downtrend, this would work the same. By the way, don't forget that there is an ultimate trading ebook that works in combination with this video. And with this ebook, you will be able to learn when to easily enter a trade and when to exit from the trade to ensure minimum losses with maximum profits. This ebook will help you understand forex trading from scratch, starting from your need to understand the fundamental concept of supply and demand that governs forex trading as a whole, including how to avoid false breakouts while trading, to how you can manage your risks, plus so many other important topics that we can't simply cover on this short video at once. It is an ultimate ebook that will surely expose you to the secret of becoming a professional forex trader that can manage both psychological and live trading risks to eventually become a professional daily trader with the highest possible sense of confidence needed in the game. So to get this ebook, contact Johnson Job through the WhatsApp number on the screen or purchase it directly from our official website at edumers.com and download it into your phone to proceed with your studies immediately. So moving into the next pattern, the triple top and triple bottom pattern. So price is an uptrend before it makes three same highs in a row, forming the triple top pattern. The swing lows here creates the neckline and support level, and when it breaks, you would take trade entry shots as a reversal is now confirmed. Now I'm going to the other way. Price is in a downtrend before it makes three same lows, forming a triple bottom pattern. The swing highs here creates the neckline and the resistance level, and when it breaks, you will take trade entries long as the reversal is now confirmed. So using the triple top and triple bottom pattern in the same as the four variations we showed you for the double top and double bottom pattern, so we won't go through it again. Moving to the next pattern, the trend continuation pattern. A bullish trend continuation pattern has your runs and pullbacks. The swing highs are higher than the previous swing highs. The swing lows are higher than the previous swing lows. This means a bullish trend continuation pattern makes a higher high and higher lows. From a price action standpoint, it shows a continuation of bullish momentum from the buyers through making new higher highs and new higher lows and other sideways markets. Now going the other way, a bearish trend continuation pattern has your runs and pullbacks. The swing highs are lower than the previous swing highs. The swing lows are lower than the previous swing lows. This means a bearish trend continuation pattern makes a lower highs and lower lows. So from a price action standpoint, it shows the continuation of bearish momentum from the sellers through making new lower highs and new lower lows, and not a sideways market. Now moving to the next pattern, the trend change pattern. In a bullish market, there are two ways that trend change pattern can form. Variation 1, you have a moving uptrend with a higher highs and higher lows before price makes a lower lows, giving you your trend change pattern in a bullish market variations. Variation 2, you again having a moving uptrend through higher highs and higher lows before price makes both a lower highs and lower lows, giving you your trend change pattern in a bullish market. So from a price action standpoint, it shows a loss of momentum from the buyers as price fell to make a new higher highs and instead created a reversal pattern. Now going the other way, in a bearish market, there are two ways the trend change pattern can form. Variation 1, you have your moving downtrend through lower highs and lower lows before price makes a higher high, giving you the trend change pattern in a bearish market. Variation 2, so you have your moving downtrend again through lower highs and lower lows before price makes both higher lows and higher highs, giving you your trend change pattern in a bearish market. So from a price action standpoint, it shows a loss of momentum from the sellers as price fell to make a lower lows and instead created a reversal pattern, showing a trend change from a downtrend to an uptrend.
Welcome back. It's another day. Sure, live trading is when you actually confirm if truly your trainer is a mentor. I mean, being a mentor means if truly your trainer is teaching you whatever he or she is practicing on a daily basis. Are you getting the point? If not a mentor, you will only be an advisor. I mean, someone who only reads to teach. Are you getting my point? So with that being said, dive to our computer and we analyze some charts before we now enter our trade as normal. So it's another day episode. And also, let it be a new energy for us. So let's go. I believe you all have tuned on to you have all put your computer on magnifying screen. I mean, if you are watching us from our YouTube live now, magnify your screen so that you can see all the candlesticks working perfectly fine. I mean, and also, if you are watching from YouTube.
Before we continue, let me quickly share this amazing opportunity with you as well. Do you know that you can also join our Edumers live trading streaming network with our boss Johnson Job to grow your little capital on daily basis as you continue learning to become a professional day trader like us? There is a paid access streaming page on our official website at edumers.com that will help you join this daily program with a secret password. And as a beginner, if you are afraid of losing your first little capital, then this live trading program is for you because it won't only grow your little capital but will help you grow your confidence until you start trading alone someday as a professional trader. So if you are interested, click on the second link in the description of this video or contact Johnson Job through the WhatsApp number displayed on the screen to learn more about how you can pay and get your secret password to join the program as well. Moving on, the head and shoulders and inverse head and shoulders pattern. So before we continue, if you are enjoying this video and want to show your support, please hit the like button right now. Left shoulder, the head of the swing high and then the right shoulder at the lower high. The swing lows here make a neckline or support level. From a price action standpoint, it shows a loss of momentum from the buyers and the start of a trend change as the lower high is already formed. Now there is a higher quality of head and shoulder pattern, which is head and shoulder pattern with a slanted neckline. It is the same as the normal head and shoulder pattern, except you already have a lower low that form, creating the slanted neckline. From a price action standpoint, this is a higher quality reversal pattern because price already made both a lower low and lower highs, which shows a fully formed trend change, not just the start of a trend change. Now going to the opposite direction, the inverse of head and shoulders pattern starts with your moving downtrend. Left shoulder, the head of the swing low and then the right shoulder at the higher lows. The swing highs make a neckline or resistance level. So from a price action standpoint, it shows a loss of momentum from the sellers and the start of a trend change as higher low has already formed. Now again, there is a higher quality inverse head and shoulder pattern, which is an inverse head and shoulder pattern with a slanted neckline. Again, it is the same as the normal inverse head and shoulders pattern, except you already have a higher high that's from creating a slanted neckline. Now from a price action standpoint, visit the higher quality reversal pattern because price already made both a higher high and higher low, which shows a fully formed trend change, not just the start of the trend change. So this same brings us to our next question, which is how do we use the head and shoulders pattern as part of our trading strategy? Again, right now, go to the comments below and let us know exactly what questions you have and topics you want us to cover next. And also, if you are enjoying this video, hit the thumbs up button to show your support. Now, these are the 3 core variations to use in the head and shoulders pattern. Let's start with the first, which is the neckline break entry. You first had your head and shoulders pattern that forms neckline here because of these 2 points, and once price breaks the neckline and makes a lower low, you will take a breakout entry short as the reversal and trend change is now confirmed. Going the other way, first have your inverse head and shoulder pattern that forms neckline here because of these 2 points, and once price breaks the neckline, it makes a higher high, you will take a breakout entry long as the reversal and trend change is now confirmed. So moving to the second variation, head and shoulders or inverse head and shoulders pattern followed by the neckline breakout instead of taking the breakout entry, waiting for a pullback entry. So you first have your inverse head and shoulders pattern, neckline here, neckline break, but instead of taking the breakout entry, there was a second long entry on the pullback to the new support level. Now going in the opposite direction, this would work the same. So moving on to the third variation, which is an aggressive early entry at the right shoulder of the pattern. So your regular entry would be identifying the head and shoulders pattern and taking a trade entry short at the break of the neckline here, but now here is a more advanced way to trade the head and shoulders, which is what we call an early aggressive entry right at the right shoulder of the pattern here. So let's break it down. You first identify the left shoulder and the head. Now here is the key. The left shoulder here already makes a resistance level, so you would have had it drawn in and extend it out as price comes back up to this resistance level. You would wait to see if you would get candlesticks forming at the level created by the left shoulder, which you got to the multiple long wick candles forming at the level. Then at this point, you will look inside of this area to see if you get any form of price action that signals a trend change to confirm that this right shoulder has completed. So let's pull up a lower time frame, specifically the 4-hour time frame, and put up beside this one. On the left is the daily time frame we just looked at. On the right is 4-hour time frame of the same asset. This resistance level here is the same resistance level here. This area here where the candlestick form is the same area here, the 4-hour time frame. Now on the 4-hour time frame, you had a perfect descending triangle pattern that forms right at the right shoulder and resistance level from the higher time frame. When the pattern breaks below, this reversal from an uptrend to a downtrend is now confirmed and also confirms the completion of the right shoulder from the higher time frame. Now after you have the break, you would go to the lower intraday time frame to take trades entry shots using our entry strategy and tool. Now moving on to the next section, triangles, channel and wedges. These patterns work as a set because of how we use them as part of our strategy, and you will see one. So let's first go through the three core patterns, starting with the triangle pattern. The triangle patterns has its three variations as well. So we will start with the ascending triangle. So the top side of the ascending triangle makes same highs and creates a horizontal resistance level. The bottom side of the pattern makes higher lows and allows for ascending trend lines to be placed. This pattern then forms in both bearish and bullish markets. The bullish ascending triangle starts with an uptrend followed by the pattern formation. The bearish ascending triangle starts with a downtrend followed by the pattern formation. So next, the descending triangle pattern. The bottom side of the descending triangle makes same lows and creates a horizontal support level. The top side of the pattern makes a lower highs and allows for descending trend line to be placed. This pattern then forms in both bullish and bearish markets. A bullish descending triangle starts with an uptrend followed by the pattern formation. A bearish descending triangle starts with the downtrend followed by the pattern formation. So next, the symmetrical triangle pattern. The top side of the symmetrical triangle makes low highs, which allows for descending trend lines to be placed above. The bottom side of the pattern makes a higher lows, which allows for an ascending trend lines to be placed below. This pattern then forms in both bullish and bearish markets. A bullish symmetrical triangle starts with an uptrend followed by the pattern formation. The bearish symmetrical triangle starts with the downtrend followed by the pattern formation. So we will be showing you how to use this once we get to the strategies section. Now before we continue, this is the most important concept of this entire video. When you are drawing your trend lines, when identifying patterns, treat them as approximation and areas. The reason for this is because the market is imperfect and patterns won't always form picture perfect or exactly how you want them to form. If you just wait for picture perfect by the book pattern, you will miss out on 90% of the best trade because again the market is imperfect, price movement is imperfect, and to get good at trading you need to learn how to operate within an imperfect noisy market. Moving to the next pattern, which is the channel. The channel pattern has three variations. Let's start with the first, which is the ascending channel pattern. So the top side of the ascending channel makes higher highs, which allows for an ascending triangles to be placed. The bottom side of the pattern makes higher lows, which allows for an ascending trend line to be placed. The two trend lines are parallel to each other and are both in an upward direction. This pattern then forms in both bullish and bearish market. A bullish ascending channel starts with an uptrend followed by the pattern formation. A bearish ascending channel starts with a downtrend followed by the pattern formation. So next, the descending channel pattern. The top side of the descending channel makes lower highs, which allows for a descending trend line to be placed. The bottom side of the pattern makes lower lows, which allows for a descending trend lines to be placed. The two trend lines are parallel to each other and are both in a downtrend direction. These patterns then form in both bullish and bearish markets. A bullish descending channel starts with an uptrend followed by the pattern formation. A bearish descending channel starts with a downtrend followed by pattern formation. So next, the horizontal channel pattern. The top side of the horizontal channel makes same highs, which allows for a horizontal resistance level to be placed. The bottom side of the pattern makes same lows, which also allows for a horizontal support level to be placed. The two levels are parallel to each other and in a horizontal direction. This pattern then forms in both bullish and bearish market. The bullish horizontal channel starts with an uptrend followed by the pattern formation. The bearish horizontal channel starts with the downtrend followed by the pattern formation. So right now, if you are enjoying this video and want to show your support, please hit the like button as it goes a long way for us. Now moving on to the next pattern, which is the wedge pattern. So the wedge pattern has two variations. Let's start with the first, which is the rising wedge pattern. The top side of the rising wedge makes a higher high, which allows for a rising trend lines to be placed. The bottom side of the wedge patterns makes a higher low, which also allows for rising trend line to be placed. Now the key here is that the two trend lines are converging and are both in an upward direction. These patterns then form in both bullish and bearish markets. A bullish rising wedge starts with an uptrend followed by the pattern formation. A bearish rising wedge starts with a downtrend followed by the pattern formation. So next, the falling wedge pattern. The top side of the falling wedge makes a lower high, which allows a falling trend lines to be placed. The bottom side of the pattern makes lower lows, which also allows for a falling trend lines to be placed. Now the key here is that the two trend lines are converging in the both and downward direction. This pattern then forms in both bullish and bearish markets. A bullish falling wedge starts with an uptrend followed by the pattern's formation. A bearish falling wedge starts with the downtrend followed by the pattern formation. So now that we've covered the three core patterns formation, let's get into how to actually use the triangles, channels and wedges as part of our strategy. So the foundation of using triangles, channels and wedges in trading in the direction of where the patterns breaks from, meaning this here can be any of the pattern variation we showed you. If the patterns then breaks above trade in that direction, if the pattern breaks below trade in that direction. So here are all the strategy variations. Let's start with the first. Identify a trend followed by a pattern formation and then a pattern break in a main trend direction. This is a trend trading strategy. This is the Tesla stock. You have your moving uptrend before descending triangle pattern forms. Again, to be clear, this here could have been any of the patterns from this list, but in this case we had the descending triangle pattern that formed. Now price breaks above like this would signal a trend continuation as price broke in the same direction as the larger moving uptrend as it takes bullish momentum to break the pattern and makes a higher high. You would then take a long trade to the lower intraday time frame as the trend continuation is now confirmed. Let's show this again. This is Ethereum. You had a moving uptrend before the descending triangle pattern formed. Again, it could have been any pattern in this list that formed, but in this case you had a descending channel. Now price breaks above like this, you would then take long trade through the lower intraday time frame. Now going the other way in a downtrend, this was the same. You have your moving downtrend before a descending triangle forms. Again, it could have been any pattern from this list, but in this case you had a descending triangle. Once the pattern breaks below, meaning it breaks in the same direction of the longer moving downtrend, you will take trend continuation trade short. Now moving on to the next variation. Identifying a trend followed by a pattern formation, but then a pattern breaks in the opposite direction of the main trend. This is a reversal trading strategy. So you first have your moving uptrend before an ascending triangle pattern forms. It could have been any pattern from this list, but in this case you had an ascending triangle. Now the pattern breaks below and in the opposite direction of the main uptrend, signaling a reversal and trend change from an uptrend to a downtrend. So in this case you would take trade entry shorts after the break below. Now going the other way in a downtrend, this works the same. You have your moving downtrend before a falling wedge pattern forms. Again, it could have been any pattern on this list, but in this case you had a falling wedge Now the pattern breaks above and in the opposite direction of the main downtrend, signaling a reversal and the trend change from a downtrend to an uptrend. You would then take trade entries long to the lower intraday time frame. Now moving on to the next variation, identifying a trend followed by a pattern formation followed by a break in a main trend direction, but instead of taking a breakout entry, waiting for a pullback entry. This is a trend trading strategy, and this is the Microsoft stock. You had your moving uptrend before an ascending triangle pattern form. Again, it could have been any pattern from this list, but in this case you had an ascending triangle. So like we previously showed you, once price breaks above, you could have taken a breakout entry long right away. Now most secure traders would wait to see if there was a pullback that occurred, which you had here through the multiple long wick candles reacting to the new support level and top side of the pattern, where the moving average also cross, which creates an area of confluence. Then once you had an intraday trend change, you would have trade entries long using our entry strategy and tool. Again, whether you trade the breakout or you wait for the pullback, both works fine. It all comes down to your style of trade. Now breakout entries and pullbacks entries require you to place a stop loss at different places, which is very important point to understand, and we will discuss further later on. Now moving on to the next variation, identify a trend followed by a pattern formation and then a break in the opposite direction, but instead of taking a reversal breakout entry, waiting for a pullback entry. This is a reversal trading strategy. This is the Coinbase stock. You had your moving uptrend before the descending triangle formed. It could have been any pattern on this list, but on this case we had a descending triangle. So like we previously showed you, once price breaks below, this would signal a reversal and uptrend to a downtrend. You would take breakout entry short. Now most secure traders wait to see if there was a pullback that occurred, which you had here with the long wick candle forming right at the new resistance level and bottom side of the pattern, and where the pattern trend line crosses, giving you an area of confluence. Then once you had an intraday trend change, you would take trade entry short using our entry strategy and tool. Now moving on to the next variation, the pattern forming at a key level. You first identify a key level through these reversal points. Now as price came back down, you had a descending channel pattern form at the key level. Again, it could have been any pattern from this list, but in this case you had a descending channel form. Once price breaks above, the reversal is confirmed and you would take trade entries long. Now moving into the final variation, identify a key level followed by a candlestick formation and then a pattern inside. Now before we continue, go to the comment section right now and tell us exactly what videos you want us to create next. So this is the Microsoft stock again. We covered this earlier where you had your pullback entry here. Now there was a second entry using the new variation, so let's list a pro trade working in your favor. First, you are trading with your moving uptrend. Next, you have the momentum from the pattern break here and the long trade entries that took place here. Then you had the area of confluence here where the trend lines, new support level that recently formed and moving average, and fifth level or cross. As price came back down to this level, you had multiple perfect long wick candles reacting to the area of confluence. So after you had the candles reacting to the area of confluence, you need to look inside of the candles and inside of this area to find price action that signals a trend change from a downtrend to an uptrend, because even though this is a strong moving uptrend here, this here is a short-term downtrend, meaning price can stall at this area of confluence and then breaks right through, triggering a larger trend change. Now on key notes, when you look inside of this area, it doesn't have to be a wedge, triangle or channel, but it can be the previous pattern we showed you in this video. All the reversal pattern works the same. So let's pull up the daily time frame and put up beside this one. The chart on the left is the Microsoft weekly time frame we just looked at, and on the right is the daily time frame. This key level here is the same key level here. This area of confluence here is the same area here. Again, we are looking for any form of price action that signals a trend change from a downtrend to an uptrend. So what we had in this case here was a perfect descending triangle pattern that forms right at the area of confluence from the weekly. Then once price breaks above, it makes a higher high. The trend change is formed from a downtrend to an uptrend. Now here's a very key point. Notice how price don't go straight up after they break and pulls back slightly before actually taking off upwards, and this is why you need the two most important parts. One, to go to the lower intraday time frame to identify an actual entry point after they break using our entry strategy, and two, understand precision stop loss placement, as there is a very specific place to put your stop loss when trading the breakout, and another very specific place to put your stop loss when trading pullbacks. Now we have a very important question we need answer to. Do you guys like the longer, more detailed, in-depth videos, but as a result it takes a long time to create and release, or would you rather have shorter and less detailed videos but then allows for more videos to be released faster and more often? Let us know in the comments below. So if you enjoyed this video, to show your support, please hit the like button, subscribe and turn on the notification bell. Thank you.